Hello, everybody. My name is Lush Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. I had a question on YouTube on how to invest in today's environment and would be more than happy to answer. So, today's environment is one of inflation, market volatility, and war. So when we have inflation, you should be investing in companies that have pricing power by having a name brand or being essential so the company can pass the price increases on. For example, companies with strong brands or that operate oligopolies can pass price increases on to consumers. During times of inflation, commodities also tend to go up. Things like energy are generally positively correlated with inflation. Another idea is real estate, especially with some of the discounts that we're seeing lately. Real estate has been overpriced because of the low interest rates and cheap money that we've had for the last 20 years. And with higher interest rates, the carrying costs are becoming higher and the prices thus need to come down. Various studies show about a 15% reduction in Canadian real estate already, and a possible drop of 20 to 25% from the February highs being expected. Another thing you can look at is financials because banks benefit from increasing spreads between what they pay out on the savings accounts and what they can charge in interest on the loans. And insurance companies get better returns on the safely invested premiums, generally in bonds, since bonds are now getting better interest rates. And during times of inflation, stocks will outperform in general. Stocks and stock funds are indirect hedges against inflation. It may seem surprising these days because the markets are volatile and are reacting with sell offs to the news of inflation increases. But over the long haul, stocks tend to do all right when inflation rises. The reason is simply that inflation applies to all assets, including stocks. Many companies have pricing power that allow them to raise prices. Moreover, if workers are getting raises in their wages, they can afford a little more in dollar terms to invest in stocks or just to buy other things in general. And the stocks will be averaging 8, 9, 10% a year, while inflation over the long run is averaging 3. Other types of investments to consider during times of inflation would be mature dividend payers that increase dividends by more than the inflation rate. Look at companies with strong balance sheets so they're not getting killed by high interest rates on their debts. Look for companies that are not exposed to labor increases. So, for example, have contracts and also do not have supply chain issues. Inflation linked bonds or inflation protected bonds like the US TIPS are another way to go. And you can look at bank loan funds, which are mutual funds that buy loans made by banks or other financial institutions to companies. These bank loans are usually senior secured debt and are mostly rated below investment grade because the borrower's ability to repay may be viewed as speculative. Bank loan funds are not tightly linked to inflation, but they adjust up and down with changes in interest rates, so that makes bank loan funds largely impervious to rising interest rates. Bank loans have several risks. They tend to be mostly below investment grade, as I mentioned, or unrated loans, so you have credit risk. Moreover, they can carry some liquidity risk. You may not be able to get your money out. You should not be buying during times of inflation. Price takers. You should not be buying companies with a lot of debt, which could include utilities. Do not buy high valuation growth companies whose future expected cash flows are discounted more during a high interest rate environment. And by the way, gold isn't an inflation hedge either. It's more of a fear buy when stocks are going down, but will not necessarily do well during inflation. Looking at what happens during wartime. Oil will do well because of the uncertainty, especially if the war involves an oil producing country, which in this case it does. Any company that supplies weapons or war related materials, just as examples Raytheon, Lockheed Martin, Northrop Grumman, and General Dynamics. Anything produced by any of the belligerents will become more expensive since there will be less of it, assuming that the production has to stop or at least slow down. Seek out the quote unquote cockroaches, the stocks that can survive disasters. For me, that's traditionally been financials, utilities, healthcare, and phone companies. Today, it also includes high quality technology, currently profitable companies that are reasonably valued. Don't buy anything that is consumer discretionary, since people who are afraid typically don't buy nice to haves. And at the start of a war, any war, markets will go down, but quickly recover and keep going up, usually reaching new highs before the war even finishes. There is no long term harm to the markets from a war. So, those are my thoughts on what to do during the markets that we are facing in 2022. If you have any requests on what you'd like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.